So good afternoon, good evening. Welcome to our revision class today. So we are doing revisions. We are doing revision, block revision. We are doing block revisions. We're doing block revision and we're doing marginal and absorption costing. Marginal absorption costing. So under marginal and absorption costing, there are a number of things you're supposed to know. One of them is that you need to prepare the income statement under marginal and absorption costing. You need to know what is marginal costing and what is absorption costing and the differences. And then you need to know how to prepare the reconciliation statement. So marginal costing, income statement under marginal costing, you're supposed to know how to prepare the income statement under marginal and absorption costing. Number two, you're supposed to know what we call CVP analysis. And number three, non-routine decisions. Those are this, and more so we're going to focus on the income statement and CVP analysis. The non-routine decisions, we're going to look at them later on, but mostly our main focus is going to be the income statement under marginal and absorption costing. So briefly, marginal costing is whereby the manufacturing costs are composed of only variable costs of manufacturing. So the valuation of opening and the closing stock, production cost under marginal costing, production cost, so cost of sales is composed of only variable manufacturing cost. And the stocks are also valued based on the variable manufacturing cost. And then absorption costing, the production cost is a combination of both variable manufacturing and fixed overhead manufacturing cost. Under absorption costing, the total production cost is a composition of two items, variable production cost and marginal production cost. So those are the major differences. And the opening and the closing stock under absorption costing is valued based on the total production cost. So without wasting time, let us look at a few questions here and there. And then the first question we're going to look at is December 2013, question number 3B. 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 So the question reads, Progress Limited manufactures a single product. The standard cost per unit is as follows. Direct materials 8, direct labor 30, variable selling cost 2 shillings. So the total cost is 40 per unit. And then additional information, the budgeted fixed production overheads per annum amounts to 7,200,000. The normal production level per annum is 2,400,000 units. In the month of April 2013, the number of units produced and sold were 240,000 units and 200,000 units respectively. The fixed selling cost per month amounts to 1.5 million. The selling price per unit is 50 shillings and there are no inventories. So required income statement for the month of April 2013 using absorption costing and marginal costing. So we're going to write here Progress Limited. Progress Limited here. Progress Limited. Income statement. For the month of April 2011, for the month of April 2011, marginal costing. Then you are going to underline. So we can have two columns here, shillings and thousands, and then here shillings and thousands. So when you're told to prepare income statement, so it means you start with the sales figure. So you start with the sales figure here. So the total sales value, so the total note number three, so they produced 240,000 units and sold 200,000 units. So they sold 200,000 units and the selling price per unit is 50. So they sold 250 and the selling price is, they sold 200,000 units. So 200,000 times 50. So this one is going to give you 10,000 here. And then you less marginal cost of sales. Marginal cost of sales. So you start with the opening stock. Some question on how the opening stock units. In our question, the opening stock was not there. Supposing it was there, you'll be given the opening stock units, you'll value them using the marginal production cost per unit. So that is variable production cost. In this question, the variable cost is composed of direct materials and direct labor. Those are the variable component, those components that varies with production. So the one unit is valued at, so here you'll have valued the units at 38. If we had opening stock units, you will value them based on the variable manufacturing cost per unit, which is composed of direct labor and direct materials, and sometimes variable production cost. So here we don't have, and then you add production cost. The total units that were produced is 240,000. You multiply by 38. When it comes to production costing, when you're using marginal costing, you value the production cost based on the marginal production cost per unit. That is variable production cost. So this one is going to be 240 times 38. So this is going to give you 9120. And then you less closing stock. Closing stock, they produced 240,000 units and they managed to sell 200,000. The production was 240 and the sales was 200. Therefore, 40,000 units were retained. That is the closing stock. You value it based on the variable manufacturing cost. Remember, variable manufacturing cost is composed of those elements that varies with production, which include labor and material and variable production overhead. So you value it, you multiply 40 times 38. This one will give you 1520. So you take 9120 minus 1520. So the cost of sales here, marginal cost of sales will be 6,600. And then here you go gross contribution, which is 10,000 units minus. So this one is going to be 2,400. And then you less other marginal expenses or costs. Marginal expenses that are non-production in nature. Like in this question, we've been told, this question, the fixed selling costs, variable selling cost is 2 shillings per unit. So variable selling here, you less variable selling. Variable selling is 2 shillings. So you multiply by the total number of units that were sold times 2. So that one is give you 400. So you get here net contribution. You get here what you call the net contribution, which is 2,000. And then you less fixed cost. Fixed cost or expenses. So you less fixed cost or expenses. So start with the fixed selling expenses. Fixed selling expenses was note number 4, 1,500. So you less that one fixed selling, 1,500. And then you less fixed production overhead. Fixed production overheads. Fixed production overheads. The fixed production overheads per annum was 7,200,000. So this was the total fixed production overhead for the whole year. So you divide this one by 12 because you're doing it on monthly basis. So this is the fixed production overhead 7,200. You divide by 12. So you get that this is 600,000. So you get this to 600,000. This is the total fixed production overhead for the whole year. And remember, we're only preparing the income statement for the month. So you only consider those ones that are for that month, which is you divide by 12. So this one will be 2,000. We don't have any other fixed expenses. You minus 1,500, and then you minus 600. So you get negative net loss of 100 here. So that one will be there under marginal costing. So key things to note here, that the valuation of opening stock is based on the variable production cost. Variable production cost is composed of variable materials, that is composed of material cost, labor cost, and sometimes variable production cost per unit. So you value opening stock units based on the variable production cost. Production cost is also valued on the variable production cost per unit. In our question, it was 38, which is composed of material and labor cost. Closing stock at the same time is valued based on the variable production cost. So that is the key highlights. And then now you consider other variable expenses first, marginal expenses or variable expenses first, before now you consider the fixed cost. So here you come here and write Progress Limited. Progress Limited. Income statement. For the month of April 2011, absorption costing. And then you underline. So you can also have two columns here. So we have the sales figure here. The sales figure will still remain 200,000 units. And then you multiply by 50. This one will still give you 10,000. And then here you less cost of sales. You less cost of sales. So you have the opening stock. Opening stock. Some question will have the opening stock. In this question, we do not have the opening stock. So you take the opening stock. Now, how do you value the opening stock under absorption costing? You value it based on the total production cost. Total production cost is a combination of variable manufacturing costs and fixed overheads. So the variable manufacturing cost is 38 shillings per unit. And then the overhead, the fixed production cost, the total fixed production cost was 7,200,000. The total fixed production cost for the whole year was 7,200,000. And this was for 2,400,000 units. So when you take 7,200,000 and then you divide by the number of units, you get the cost per unit is 3 shillings. So the fixed overhead cost per unit is 3 shillings. So you add 3 here. The total now will be 41. 38 plus 3, that one will give you 41. This was the total overhead for the whole year and standing for 2,400,000 units. So the total fixed production overhead, the total production cost will be 41. So this one will be 0. And then you add production cost, production cost, it will be 240,000 units were produced, you multiply by 41. So 240, you multiply by 41. That one will give you 9840. And then you less closing stock. Closing stock would be 40,000, and then you value based on 41. So that one will give you 1640. 1640. So 9840 minus 1640. So that one will be 8,200. So here you get the gross profit here. You get the gross profit. 10,000 minus 8,200. So your gross profit here will be 1,800. 1,800 there. So under absorption costing, we also have over and under absorption. So we have over and under absorption. So how does it come? So you check the normal production level. The normal production level. According to them, so they are producing, according to this question, they suppose the normal production is 2,400,000 units for the whole year. So when you divide by 12, the normal production per month should be supposed to be 200,000 units. But now for this month, they produced 240,000 units. So they exceeded the normal production by 40,000. So you check the normal production vis-a-vis the actual production. The normal production is supposed to be 200,000 units. How do I know? You get the total number of units that are supposed to be produced in the whole year, you divide by 12 per month. So the normal production is supposed to be 200,000 per unit, so per month. But in this question, the actual production was 240, so they were produced. If there is overproduction, you add the difference. So here you say over absorption. In other words, over absorption here. So it will be the difference between the actual production, which was 240, minus the normal production, 200,000, and then you multiply by the variable cost per the fixed production cost per unit. Check the actual production vis-a-vis the normal production. If the production is in excess, then you add the difference. That is overproduction. So 240, that is 40,000, which was in excess times 3. So this is 120. So you add 120. If you underproduce, you reduce from your profit. I hope I'm clear here. Under and overproduction, how does it come about? You check the normal production. How do you know the normal production? The normal production units in the whole year is 2,400,000. So you divide by 12 to know the normal production per month, because this statement is for the month of April only. It's for 1 month. So therefore, per month, they're supposed to be producing 200,000 units. But in this month, they produced 240. So they were produced by 40. That overproduction, you multiply by 3 to be overabsorption. You add to your gross profit. And then you less now expenses here. You less expenses. So you start with fixed selling expenses, which was 1,500,000. So 1,500,000. And then we had variable selling expenses, which was 600,000. So here you get the net profit. So it is negative. This is 10. Variable selling expenses was 400. Sorry, this was a 400. So the profit here is 20. So the net profit here is 20. Some question required to reconcile. So this is how you make reconciliation statement. So you take profit as per marginal costing. Profit as per marginal costing, which is negative 100. Then here you do adjustment of stock. So you write here marginal minus absorption. So you start opening stock. It was zero. You less closing stock. You less closing stock. Under margin of the closing stock was 1520. So you less here. Minus the closing stock here is 1640. So this one is going to be negative 1520. Negative 1520 minus negative 1640. Negative 1520. Negative 1520 minus negative 1640. It's going to give you 120. It's going to give you 120. So negative 100 plus 120. So this is 20. That's profit as per absorption costing. Profit as per absorption costing. That is how we do that one. So that is question 2013, question 3B. So in case you have a question, you can ask. Any question? So we can also do another question of the same kind. We can do the same question of the same kind. Let us check 2015, May 2015. May 2015. May 2015. May 2015, question number 3B. May 2015, question number 3B. May 2015, question number 3B. So the question reads, XYZ Limited has provided the following details for the month of April 2015 in respect of production and sales. Sales 10,000 units, production 12,000 units. Cost data per unit of output, selling price is 1,000, direct material cost is 360, variable production overhead 60, fixed production overheads 1980,000. Fixed selling expenses 300,000, fixed administrative expenses 500,000. Additional information: variable selling cost is 10% of sales. Normal production capacity is 11,000 units. Required income statement for the month of ending 30th April 2015 using marginal costing, absorption costing. So here we're going to write XYZ Limited. XYZ Limited. Income statement. Income statement for the months of April 2015. Marginal costing. Marginal costing, then you underline. So you can have your shillings and thousands. Shillings and thousands. So we have the sales. The sales figure is 10,000 units. And then the selling price per unit Selling price per unit is 1,000. So you multiply it by 1,000 there. So 10,000 times 1,000. So that one will give you 10 million. So here we have 10,000. It's in thousands. And then you less marginal cost of sales. Marginal cost of sales. So we have the opening stock. Opening stock. In this discussion, we had no opening stock. But supposing it was there, you value it based on the marginal production cost per unit. The marginal production cost per unit was direct materials 360, direct labor cost was 80, and variable production overheads was 60. So it will be 360, that is material cost, direct labor 80, plus variable production cost, which is 60. So it is 500 per unit. So 500 per unit. So if we had the opening stock units, you'll value them based on the 500 per unit. What is 500? This is the variable production cost, which is composed of material cost, labor cost, and variable production cost per unit. When you add all those costs, you get 500. So here we had no, and then you add production cost. You add production cost, the total number of units that were produced. They produced 12,000 units, and then you value them based on 500 per unit. So 12,000 times 500. So that one will give you 6,000. And then you less closing stock. Closing stock, how many units were produced? Closing stock units. So they produced 10,000, they sold, so they produced 12,000 and they sold 10,000. So they retained 2,000 units. So here you multiply 2,000 by 500. 2,000 by 500. So this one will give you 1,000. So 1,000. So this one will give you 5,000 here. So the total, the marginal gross contribution will be 5,000. Gross contribution would be 5,000. Then you less variable expenses. You less variable expenses. So we have variable selling expenses. Variable selling costs are 10% of sales. So variable selling is 10% of sales. 10% of 10,000, which is 1,000. So gross contribution will be 4,000. So the net contribution, is 4,000. And then you less fixed cost or fixed expenses. Fixed cost here. So we start with the fixed administrative. Fixed admin expenses. Fixed admin expenses is 500,000. So you less 500,000 here. And then fixed production overheads. So fixed production is 1980. So you less 1980. So this one you less 1980. You less the total fixed production there, 1980. So this 1980 was for 12,000 units. So 19, you less 1980. So you get the net profit or loss. So this is 1520. So we come here and write XYZ Limited income statement. For the month of April. For the month of April 2015, absorption costing. So you write here the sales figure, which is 10,000, you multiply by 1,000. So this one will still give you 10,000 here. Shillings and thousands, and shillings and thousands. And then you less cost of sales. So you start with the opening stock. If the opening stock was there, you'll have valued it based on the total production cost, which is a combination of the variable cost per unit plus the fixed cost per unit. So how do you get the fixed production cost per unit? How do you get the fixed production cost per unit? How do you get the fixed production cost per unit? So for you to get the fixed production, the total overhead for the total overheads was 1980,000. This one was for 11,000 units. This was the fixed production overheads for 11,000 units. So you divide this by 11,000. So you get it is 180 per unit. So the 180 here. So the fixed production cost per unit, fixed overhead cost per unit was 180. You add it to the variable production cost per unit. So the total production cost will be 680. 680. So here you'll have valued it based on 680. How are you getting this 680? 680, we're saying it's a combination of variable production cost per unit, which is 500, plus the fixed overhead cost per unit. Fixed overhead cost per unit in our question is 180. The total fixed production overhead was 1980, and this is for 11,000 units, the units that were produced. If you've been given the block figure for fixed overhead costs for that period, then it relates to the total number of units that were produced for that particular period. So you divide in order to get the cost per unit. This cost per unit, you combine it with the variable production cost per unit, and then you get the total production cost per unit. So here will be 0. And then you add production cost, they produced 12,000 units, and then they produced, the normal production is it is 11,000. So the fixed overhead is based on the normal production of 11,000. So production, they produced 12,000 units. So here you multiply the total production, which is 12,000 units, you multiply by 680. So this one will be 8160. And then you less closing stock. Closing stock would be 2,000 units, 1,000 units, sorry, 2,000. 2,000 units, and then you multiply by 680. So this one will give you 1360. So it's a 160 minus 1360. So that one will be 6,800. So the gross profit here, gross profit is 10,000 minus under, this one is 3,200. So here we said under absorption costing, we have over and under production. So over and under production, you check the normal capacity of production. In our question, the normal production capacities is provided for in note number 2. Normal production capacity is 11,000. Normal production, in other words, the normal production is supposed to be 11,000. And the actual production was 12,000. So there's over absorption here. So you write here over absorption. Over absorption. So you take the normal, which is the actual, which is 12,000 minus the normal, which was 11. And then you multiply by fixed production cost per unit, which is 180. So this one would be 1,000 times 180. So this is going to be 180. So you're going to add here 180. And then you less, remember here, key thing here, under absorption costing, we have what we call over and under absorption. So how do you determine over and under absorption? You check the normal production level. In this question, the normal is 11 and vis-a-vis the actual. So if you produce more than the normal, the excess is over estimation, you add that one. You multiply it by the fixed production overhead cost per unit, the excess production, and then you add it to gross profit. If you underproduce, you deduct from the gross profit. Supposing the production was less than 11,000, the difference will have been deducted from the gross profit. Then here you less expenses here. You less expenses here. So we have variable selling. Variable selling is 4,000. You less 4,000. And then you less fixed admin. Fixed administration expenses was 500. Variable selling was 1,000, sorry. So these are the only expenses we had, and then you get the net profit here. So it is 1880. And then here you come here and prepare the reconciliation statement if the question, some question required to reconcile, reconciliation. So you take the profit as per marginal, profit as per marginal costing, which is 115.20. Then adjustments of stocks here, adjustments of stock. So here is marginal minus absorption. Marginal minus absorption. So the opening stock dash closing stock 1,000 1360. So here it is minus 1,000 minus 1360. So this one is negative 23. Sorry, positive 2360. So we have minus 1,000 minus 1360. So this is 360. You add, you get plus 1520, you get 1880. Profit as per absorption costing. So that is how we do reconciliation. Any question? If you have a question, you can pause. Any question? So we're going to do the last question under this November 2011. November 2011. Sorry, May 2011, question number 4. 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 So the question read, PQR Limited is a manufacturer of sports shoes. The company uses a standard costing system. The standard cost per pair of sports shoes is as follows. Direct materials 500, direct labor 4 hours at 60 per hour, 240. Production overheads variable, fixed. Additional information. So we've been given the additional information. So the additional information is during the month of March 2011, production was 10,000 units as planned, but the sales made were 8,000 units. Number 2, the total fixed production overheads variance during the month was 100,000 adverse. The standard fixed production overheads absorption rate was based on the budgeted activity of 10,000 units. The standard fixed production overheads absorption was based on the budgeted activity of 10,000 units. There was no opening stock at the beginning of the month. All units were sold at the standard selling price. Other cost incurred during the month was follows. Selling and distribution, 20% of sales, 600,000. Administration, 100,000. Required income statement for the month of March 2011 using absorption costing and 2 marginal costing. And then here they also required you to reconcile the statement of difference between the profit loss absorption costing and marginal costing. So here we're going to write income statement for the month of March 2011, marginal costing. So here we have shillings and thousands. Shillings and thousands. So here we'll start with the sales. The sales figure here, they sold 8,000 units. 8,000 units were sold, and each unit was 1,500. That is the sales. So the total will give you 12,000 here. The total will give you 8,000 multiplied by 1,500. So it will give you 12,000. So the total sales will be 12,012,000. And then you less marginal cost of sales. You less marginal cost of sales. You start with the opening stock in case it is there. Opening stock. How do you value the opening stock? So been given the variable production cost per unit. Variable production cost is material. We have material, which is 500. So you multiply 500, you add 500 plus 240. And then you also add 120. So the total will be 860. So you will multiply by 860. We all know now this is dash. And then you add production cost. You add production cost. So the total number of units that were produced, they produced, through the months of March, 10,000 units were produced. 10,000 units were produced. So you multiply here by 10,000. 10,000 you multiply by 10,000. So 10,000 times 860. So this one is 8,600. And then you less closing stock. Closing stock, we have how many units were sold out of the total units that were produced. The units that were sold is, so they produced 10,000. So the 2,000 units were remaining times 860. So 1720 is the closing stock. So 8,600 minus 1720 to give you 6880. So the gross contribution here, gross contribution, 12,000 minus answer. So it will be 5120. 5120. 5120. And then you less variable expenses. You less variable expenses. So variable expenses, we have variable selling, variable selling, variable selling. The variable selling expenses, the variable selling expenses is 20%, which was 600,000. Selling and distribution, variable selling and distribution, it is 60,000, 600,000, sorry, 600,000. So you less here 600. So you get there the net contribution. Sorry, net contribution, okay. Net contribution. So 5120 minus 600. So this one will give you 4520. 4520. 4520. And then you less other expenses, you less fixed cost or fixed expenses. Fixed cost, we have fixed cost, fixed admin expenses, fixed admin, fixed administration was 1,000. So you less here 1,000. And then we had fixed production. Fixed production overheads. So fixed production per unit was 100. So you multiply 100. You multiply 100 times the total number of units that were produced. So they produced 10,000 units. So you multiply here by 10,000. So in some question, they give you the total value fixed production overhead for that period in some question. So they give you the fixed production cost per unit. So you multiply by 10,000. So that one is 1,000. So you minus 1,000. And then we also had been told advanced fixed overheads. We had been told you less advanced fixed overheads. Advanced fixed overhead. Advanced fixed overhead was 100,000 advance. So you minus 100,000. So advance you deduct from both sides. So 4520 minus 1,000 minus 1,000 minus 100. So you get 24 24, just a minute. Sorry, we had 20% of sales. This one is incorrect. This one is supposed to be, fixed. So 20% of sales. 20% of sales is there. So this one is supposed to be 2,400. Sorry for that confusion. So this is 5120 minus this. So this one is supposed to be 2720. And then here we'll also have fixed selling. Fixed selling is the one that was 600. Fixed selling was the one that was 600. So this one is 20. So that is the net profit was 20. Remember, fixed selling was 20% of sales. 20%, variable selling was 20% of sales, which is 12,000. 20% of sales, according to the question. If you have the question, you can be able to see. That is November 2011. And then here we're going to prepare the income statement. Absorption costing. So absorption costing. So of course you write for the month and then absorption costing. I've shown you everything, just reinforcing. So we have the sales figure here. The sales figure, it will remain the same. 8,000, you multiply by 1,500, you get 12,000. And then you less cost of sales. Cost of sales. So we have the opening stock. Opening stock. If you had opening stock, the value will have been 0. You multiply by 960. Why 960? You add the variable cost, you add the fixed cost per unit. So the variable production cost per unit is 860 plus fixed production cost per unit, which is 100 plus 860. So here you'll have valued it based on the 960. So 960, and then you add production cost. Production cost. So the total number of units that were produced, 10,000 units were produced, you multiply by 960. So this one will give you a total of 9,600, and then you less closing stock. Closing stock is 2,000 units, you value by 960. So 2,000 you value by 960. So that is 1920. So 9,600 minus 1920, that is 7680. 7680. So 12,000 you deduct, which is 4320. That one will give you the gross profit. So in this question, we never had over and under production. The normal production capacity, the production was based on the normal production capacity of 10,000 units. This is number 3. The standard fixed production overhead absorption rate was based on the budgeted activity of 10,000 units. So we had no over and under absorption here. So we just less expenses. The production it was based on the normal production level. So we less here expenses. We less here expenses. So the first expense we less here is fixed admin. Fixed admin. Fixed admin was 1,000. You less 1,000. And then you less fixed selling. Fixed selling was 600. And then you less advance fixed overheads. which is 100. Advanced fixed overhead, which was and then we have variable selling, which is 2,400. So this one will give you 220, the profit. 200, this is the profit. And then you can reconciliation statement. So you start with the profit as per marginal. Profit as per marginal. Profit as per marginal costing, which is 20. Then adjustments in stocks. Adjustments in stocks. So you start here with the opening stock. So here marginal minus absorption. So we have the opening stock, which is dash dash, and then the closing stock. Closing stock here, the closing stock here is 1720. You minus, and here is 1920. So here we'll have negative 1720, and here 1920. So negative 1720 minus negative 1920. So 200 here, you add 200 positive, get 220 profit as per absorption costing. So that one is how we undertake those questions, how we do those questions. So now that is how we do marginal and absorption costing. So next time we'll review how to do CVP analysis and of course do another area under this topic. So in case you encounter any question that you'll be unable to do, you can always reach me. Now we'll always help each other to get the correct solution. So for now, we're going to end there. We're going to stop there. We have done 3 questions. So you can ponder over that and many other questions. So next time we'll start a little bit earlier, then finish it earlier. So thank you.